Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Today on the podcast, we have my longtime friend, Gody Khambatta, joining us. Gody has a long career as a research scientist uncovering strategies to treat cancer. And alongside his career, he's built a pretty significant real estate portfolio over the last 20 years. Most investors rely on gut feelings, shiny brochures, or hype. And that's exactly how people miss red flags and lose money. At Break of Day Capital, we do things differently. We help investors make smarter decisions before the deal ever hits your inbox. From our educational webinars to our Invest Smart book to real tools like our portfolio tracker, we're here to give you the edge most investors don't even know they need. If you've been valuing our podcast and want to take the next step, subscribe to our newsletter. You'll get early access to webinars, new investor tools, and market insights sent straight to your inbox. Break of Day Capital, because smart investing starts before the deal.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes. Welcome to the show, Gody. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, thanks. Thanks, Gary. Thanks for having me. Like you said, I've been, I live out in San Diego, California. I started my real estate journey like 26 years ago, just buying single family homes. I'm a research scientist. That's my day job. And, I've been lucky enough to kind of hit with the bug or kind of had the epiphany that investing in real estate along the way will help build passive incomes. Working at startups, working at bigger companies, you never know. When you have an employer, what the whims of the employer are. If the company will shut down and have layoffs, or just what you're in control of. So the idea to build my own passive income, something in real estate circles is always talked about now, but 25 years ago it wasn't. I was lucky I had a few mentors or people who were retiring who had to build passive income and retired early. And I took a kind of page from their book and said, hey, how can I do this? So I started by just buying my own property or my own personal residence and having a couple of roommates live with me at the time, which kind of was cost efficient and built some equity. And the market at that point was appreciating in Southern California, so I was able to kind of switch jobs, have a stronger income, and afford a rental property. So I did that a few times and grew a small portfolio of a couple of properties that built a nice little small passive income. And in 2007, I met an investment agent that pointed me to investing out of state. Hey, he said, investing in San Diego was great for appreciation, but not for cash flow at that time. And buying out of state, I was able to get way more cash flow by buying a 54 unit property out in Ohio than I could ever have imagined in San Diego. So I bought multifamily property in 2007 and kind of, it was my first property, and the investment agent kind of held my hand through it and worked with the property manager at that time to kind of learn how to manage a property, and took my bumps and bruises along the way, but slowly with that property and some other small properties along the way, I built a portfolio that now I've got about 450 units, mainly in Texas. I've kind of found good relationships and vendors in Texas. So I kind of focus on that market just because it's easier to find deals, find the right people to manage my deals there. And working from a personal portfolio, I built that individual portfolio and started, the past 6-7 years, working with mentorship groups and networking groups. I found other partners that joint venture with me, or, I've done a few syndication deals, but my focus is just building my own personal portfolio. And I found other people with that mindset to, buy our own deals, own them long term, and own them joint venture, just so we can reap the benefits of long term real estate. So yeah, now most of my deals are probably 9, 10 different assets. And I'm I've accumulated a lot of knowledge, a lot of mistakes, a lot of wins along the way, and it's built experience and expertise in what I do. And yeah, now we've got 9 or 10 different properties that I manage. I love it, and happy to chat more about some of them.
Yes. Yeah. Real estate is like owning a business. So, there's going to be ups, there's going to be downs, but, and managing through that conflict is where the real wins happen. And if you could manage through that, then that's where real wealth is on that other side. So we're just very impressive. I know recently you went through a recapitalization on one of your properties, and it was quite a bit of ride. And so I'd love to kind of delve into that and teach our listeners about that process because, maybe, if it was happening maybe 2019, 2020, it would be maybe a bit smoother. But in today's kind of volatile market, it's really, really hard to, refinance a property. So, you talk about, well, I guess let's start with like the vintage, the location, how many units, and what was the initial business plan of the property?
Sure, sure. Yeah, this is a property we bought in 2022, right? So 2022, 2021, 2022, I think pricing and this demand for multifamily interest rates are very low. So there's a lot of demand. And, we're just, the prior years is seeing a great run up in value. So there was a lot, kind of a hot market, let's say. And me and a handful of partners had kind of pooled our capital and found this opportunity. This is in the Dallas-Fort Worth, greater Dallas-Fort Worth market. And we found this first one deal. It was 120 units that we had acquired or been awarded from the broker. And a few weeks later, another deal 2 miles down the road that was also 120 units. Both were about 1977 vintage, so almost 50 years old. And they were in a market that I had already owned property. So I'd owned a property 3 or 4 miles away for the past four years prior. So I knew the market very well. I knew there was a good growth potential in that submarket. And these were nicer assets than the one nicer, newer, and better maintained assets than the ones that I originally bought. So just knowing that familiarity with the market, we thought there'd be a great opportunity. We purchased those using so we purchased those in mid 2022. We based on our underwriting, and the debt we could find at the time, we found a bridge lender that could to give us a loan for the deal, right? So the bridge loan was about I believe we got about 80% loan to value plus capital expenditures, right? So a CapEx budget to help us upgrade and renovate all the units in the property. So on top of a $24 million loan, we had a $1.5 million CapEx budget, and so we acquired that with the bridge loan. The intention was, buy the property, do our upgrade value add plan, increase the rents, and ideally we get to a point in the future where we can refi that loan and kind of take from a $24 million loan, we get a higher loan, take some cash out, and then hold that property longer term, right? So we bought that in June of 22. The kind of initial hurdle we hit when we bought it in June was, I think we literally closed on the day or the week prior to us closing the deal. The Fed raised their interest rates, right? I remember the Fed, I think it was the largest interest rate hike, the 75 basis point hike that they did in June of 2022, happened on our closing day. So that was the first kind of telltale sign. I mean, at that point, everyone thought, okay, rates are going up, but they always go up and then they come back in 18, 24 months or so and things will settle, right? So we knew we were in for a little bit of a ride or something different than the prior few years. but we didn't expect for the rates to keep going up and staying up and staying up and staying up, which is, where we're at now. All the while, the first year or two of ownership, we were able to execute our value add plan. We were able to renovate units, get about $150, $200 of additional rent, in our from the units that we upgraded. But that was into 2023, 24. We felt like our debt payments were getting higher just because the interest rates, we were basically paying close to 9-10% of an interest rate on a bridge loan, right? You're paying your SOFR rate plus 3 to 4 points on top of that. So knowing that our debt payments were so high and we had this CapEx money, we kind of slowly say, hey, we shouldn't be spending all this extra CapEx money if we know we can't kind of realize it with recapitalization anytime soon. So we kind of held on to that CapEx money kind of as a buffer after kind of year 1 or 2. And then really we just kind of held on, right? We realized, hey, our debt payments are high. We're, as much as the property is growing in income through our value add plan and relatively stable, our debt payments will kind of, be tough over these next few years if the rates don't come down. So, I mean, there was a moment that probably a couple of years in, we had to, us and the partners had to bring a little bit more additional capital just so we made sure, on top of the rate caps and this kind of our projections of where the rates are, we want to make sure we have enough debt service over the next few years to get us to our maturity or our next capitalization point. So the loan we had about a three-year term with 2 1-year extensions, right? That's a typical bridge loan. We wanted to make sure we could make it at least to the first 3 years and hope that, by the end of that year 3, that we'd be at a point where, hey, interest rates are a little bit lower, the market's a little bit different, and we have options. We really made it to about year and a half, at about 18 to 24 months in, we had the capital to kind of make it to year 3, but the question is, what do we do? What do we do when we get to that maturity, and how are we gonna land this plane? So at that point, we really, I think our debt was about 24-25 million. And based on the higher interest rates at the time, interest rates were 3%, 3.5% in 2022. Now rates are probably in the past year hovering around 5.5%, 6.5%, right? So it's going to change your profile of what type of proceeds you can get. So, I mean, looking a year or 2 in, that $25 million loan would turn into about a $20 million loan if it was done in 2024, right? So for us to recapitalize and or basically refi and get a $20 million loan would mean us partners would need to bring $5 million of additional capital just to kind of get the deal done or get the refi done. And then just, that means we're putting additional capital, 50% more than what we originally put in just to survive and without any clear plan. And that's not kind of we want to make sure we're putting more money in, but we have a clear plan over what our exit is and what's in store for us for future, good, bad, or ugly, right? So we didn't, that was kind of the scary option. Just go, can we do a cash in refi? And why would we do a cash in refi? At that time, there were the other options to consider, or we found was in Texas, there were property tax exemptions programs that were kind of being done. And they were done in 2 different ways. There were like local property tax exemptions, and there were these Romer property tax exemptions, which have kind of gained a lot of news and kind of a little bit of political controversy over the past year. So the idea is that you create more affordability at your property, and by reducing the rents to an affordable level and doing more renovations on your properties, the local housing authority will partner with you, that you'll allow them to take more voucher programs and voucher tenants, et cetera. And in return for that, you'll kind of they'll exempt the property taxes. So for example, our property taxes on our property is about 380,000 a year. So for us to reduce the property taxes by about 380,000 per year, that would be at a cap rate, like let's say a 5-6% cap rate, that's $5 or $6 million worth of pure value in the property that you've increased the property by. So that to increase the property by $5 or $6 million means that you can get more proceeds in a loan if you refi. So that $20 million loan we were talking about turns into a $24-25 million loan. And now that property tax exemption gets us to a neutral refi to continue, owning this property. So that's why it was enticing to us to pursue one of these programs. The issues we came along the way was the local. So there's two aspects. The roaming HFCs, roaming tax exemption programs, were under scrutiny because basically the housing authority that would partner with you would not be with from the local town, right? So if you're in Dallas and you're working with a San Antonio housing authority, you're basically giving the property tax, getting the property taxes exempt, and you're giving a commission to the San Antonio housing authority for creating affordability in your Dallas property. And politically, they didn't like that because you're just taking money out of one community, and just because there's an aggressive housing authority in a different community, and you're kind of pushing money away out of the community. So there was a lot of scrutiny and politics about that. And in fact, there's new legislation passed in this past 4 or 5 months that has kind of outlawed that or created much more guide rails on these. So people have done these deals, and now they've clawing back some of the property tax exemption. That it's a little bit of a mess that this still needs to be worked out. So for about 6 to 8 months, we were exploring this process, but even lenders were a little bit worried about where the kind of the final rules of this and guidelines would land. And they were kind of pulling out, going, we're not lending on this. Oh, we are lending on this, but we're creating recourse carve-outs. And all of that eventually made us kind of at some point say, look, this is a little bit too much chaos right now. We don't want to pursue this option. So what we pivoted to is let's look at the local property tax exemption. The local property tax exemption allows us to partner with, the housing authority that's down the street. They know the property, they know the community. We give them a portion of our tax savings. So if we're saving $380,000 every year, we give them 10% of that, 15% of that, right? So like they get $40,000 or $50,000 for their housing authority to run their programs to help, educate tenants, house tenants, do everything in the community they want. And then we get a good portion of that savings, obviously, to increase the value of the property and increase our cash flow and put that back into the property, right? So that would be a win-win if we could execute that. The problem with that was we're an apartment complex, we're a business, and these housing authorities are not they're government organizations. They're somewhat I wouldn't say nonprofit, but they're government-funded organizations, and they don't always move at the speed of business. And there's also at times there can be city council politics or local politics at play. So we basically had a time for about 4 to 6 months where we were trying to reach out to the head of the housing commission, or reach out to their advisor, or reach out to their legal counsel. And we gained a little bit of traction in initial conversations, but even then, a lot of local politics, and then just they weren't moving at the speed of our business, right? At the speed of our needs. We needed to get a deal done by June, right? And we started this in October, November, and come March, come April, they weren't even really kind of close to the negotiating table or close to kind of finalizing a deal, even though we had set a framework, and they were eager to get a deal. As like earlier this year, a lot of housing cuts, a lot of government cuts were made. So a lot of these Section 8 voucher programs and housing authority programs, they're running out of capital for just finding the Section 8 program. You go to a lot of communities, even in Dallas, and they're saying that we're not giving any more vouchers for our programs because we don't know where our funding is coming. So this was an opportunity, and HUD, Housing and Urban Development, has told a lot of housing authorities across the country, you guys got to do more public-private partnerships, which is exactly what we're trying to do. Unfortunately, the local politics and just the comfort level or familiarity with these public-private partnerships, because this would be the first one that was done in this community, was not there for them to get a deal done quick enough, right? So that our hope, that was a big, we were kind of setting our hopes on that deal because it could get us the most financially, without putting cash in, basically a creative deal for us, but it kind of fell apart. So we held on, waiting, hoping for it to happen. Unfortunately, it didn't. All along the way, I mean, that year leading up to our June maturity, we were pricing debt like, okay, agency's still low. CMBS is another option, right? CMBS has been a little bit more aggressive in their debt lately, and they offer interest-only loans, full-term interest-only loans, and usually with an agency loan, you'll get a full-term, you'll get interest-only for a year, 2 years, 3 years on your debt, but they will underwrite based on your interest and principal payment, and their debt service, constraint will be based on that. CMBS loans, and CMBS are banks like Morgan Stanley, Wells Fargo, Bank of America, Citi, right? These larger banks will do commercial mortgages. While their interest rates are historically higher than agency, when you can get like 6% rate with agency, you might get a 7% or 50 or 70 basis point higher with CMBS. But because they're underwriting to full-term interest only, that interest only payment would basically give us more proceeds. So what we found out was a $20 million agency loan would be equal a $24 million CMBS loan. So when rates dipped a little bit earlier this year, and we were able to get basically an application from our CMBS lender for about $24 million, and that's the deal. That's the application we ended up, once kind of the hourglass was running on us, and we couldn't get our tax exemption deal. We said, let's jump to the CMBS deal. It's 24 million. It's not the 25 we need, but it's close enough where we can get good cash flow out of the deal because it's interest only. And we had to come to our partners and say, hey, look, this is our best option at this point. Do we want to recapitalize the deal, bring a couple million more of equity, and get the deal done?
That's huge, because anyone that bought in 2021, 2022, we've all faced this issue where we had typically bridge debt, higher leverage, interest rates rising, and longer and higher than anyone could have predicted. And for that size of a loan to only come out of pocket for the amount that you did is huge. And I know it was a huge roller coaster ride. You're close, you're far, you're close, you're far, you're close, you're far. And to make it through to the other side is just that's a huge win. If you were to do it all over again, like, what would you have done differently, if anything?
Yeah, it's a good question. And these are the types of times, as hard as they are and as stressful as they are, especially if you want to be at long term, you have to approach these as, you're coming up with challenges, but these are also lessons, right? These are lessons that'll equip you for the future. So it's hard to say, hindsight is always 20/20, but going back, what I have learned is we wanted to buy this property, and my intention with my properties are generally, I don't want to hold them for just 2 years, 4 years, 5 years. I want to ideally find an asset I like and hold it for 5 to 10 years. We put bridge debt on this property when we bought it. Bridge debt is great for, holding it for a few years and refinancing out of it. But really, we should really consider your business plan, consider what your business plan and find the right debt that fits it, right? And find the right debt. We didn't foresee the interest rates going quite out of control. We knew the interest rates would be higher than 3%. This can't stay at 3% for a long time. But in hindsight, the ideal, I mean, at that time, we had the option of either buying the property with bridge debt or assuming the loan, the 3% loan or it might have been like 2.9% loan that the current owner had on it. It would have cost us an extra, we wouldn't have gotten as high leverage at 80% leverage. Maybe we would have got 75% leverage and needed to bring an extra $1 million to the closing table to get that. But if we had done that, we would have had a nice fixed debt for another 7 or 8 years, and we'd be not caring about this high interest rate market. So and that 7 to 8 year loan would have paired very nicely with our business plan that, hey, we want to own this for 5 plus 7 plus years, right? So thinking back, and knowing that we were long-term owners or potentially long-term owners, then why not pair your purchase with a kind of a longer term debt, right? Now, it's easier said than done because in some markets, like that market that's kind of hot right at that time, the way you kind of get deals awarded to you is being the best bidder or finding the right getting the best leverage so your deal works, right? So maybe we would kind of fallen off of chasing leverage and said, look, yeah, our underwritten return isn't going to be as high if we take the fixed debt versus the bridge debt, but we know we'll be safer in the long run, right? So we kind of knew the bridge debt would have got us like a few $100,000 higher in our bid, and we took it, right? We said we'll figure it out. We're good partnership group, and we did figure it out. But in hindsight, now I've got a little bit more. I'll be a little bit more stubborn in terms of making sure our debt matches our business plan.
Yeah, you, me, and many other operators as well. Absolutely.
Yeah. I mean, my crystal ball is cracked, and it's never been perfect, but we take these lessons along the way, and some of those lessons become biases when the market's changing, and maybe you don't have to cling to those old beliefs, but you do learn lessons to be a little bit more conservative and smarter along the way.
Yeah. It's, navigating these real estate cycles, the outside noise with political ramifications, geopolitical, all these different things that you've got to see how it's affecting the markets and everything there's so much that goes into it, and knowing when to buy, when to sell, when to pivot is just constantly learning throughout these times. It's crazy.
Yeah, I mean, you just have to, and all of that stuff can be noise. That was the problem with this deal is with the bridge loan, we were subject to all the market conditions because whichever way the market and interest rates blew would affect us on a month-to-month basis with how high our monthly payment is, right? Interest rates go up, then your debt service is higher. Interest rates go down, your debt service is lower. If we have a fixed debt with our multifamily loan, then we don't have to worry about any of the outside noise until our maturity, and then we can focus on operations, asset management, leasing, control what we can control. And I've done operations, leasing, asset management for 15, 20 years. So that's bread and butter for me. I don't want to have to be calling debt brokers every few months going, hey, what's pricing? What are our debt options? How do we do this? It's taking away from time on managing the asset. So it's another factor, right? If you can minimize the variables in your ownership, then you don't have to navigate them until obviously when there's a maturity, that's the time you have to face the market and see what's possible. But if you delay that time so you can execute your business plan the best you can. The benefit of our property, I mean, a lot of properties are obviously in a tight pinch these days, but we did grow our net operating income, 30% we bought it in 2022. Our net operating income when we closed this refinance was 30% higher than where we started. So we were able to execute a business plan, even though with the market softening on rental demand and a little bit in the past year, we were able to kind of bring good value to the property. So we did what we did, but the market itself made it a little bit tighter to exit with as much, with with fanfare.
And that's huge, really, to grow your NOI that much in a market, well, really in the country where you're not having any income growth and you're having higher expenses, so you're really running uphill with a boulder on your back. So that's a kudos to you. Gody, thank you so much for coming on the show and talking candidly about your recap. Like I said, everyone's going through the same thing, and it's great to see you coming out, having a positive out for your property. Where can listeners find out more about you?
Yeah, I mean, I'm happy to. I always love chatting about real estate. I don't have a huge social presence or anything, but always happy to connect on I'm more of a JV owner, individual owner, so I kind of be a straight shooter in terms of talking about real estate, but I love doing it. And you just it's as simple as my email, gody.khambatta@gmail.com. So feel free to just put my email.gmail.com, my name at gmail.com, and happy to chat.
Awesome. Well, thank you again so much for coming on the show. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.